course, everybody wants to talk about what happened on Thursday night. Watch a couple of 80-year-old guys, octogenarians, scream and shout, and so did I. I went to the Rolling Stones concert in Soldier Field, but really we will get to that, of course, and as the venerable newspaper, not the New York Times, The Onion said, nuclear war looks like a good option, but we'll get to that, and of course there's a lot of economic news that I do want to cover for sure before we get into that, and really we had some good news on Friday, and it's this thing called the PCE, Brian, and we do watch it because it's the Fed's favorite indicator when it comes to inflation.
Yeah, back in 2012, the Federal Reserve officially made the personal consumption expenditure deflator. It's quite a mouthful. They made that their target for inflation. They wanted to increase at about 2% per year. So that's their official target. It's very closely related to the consumer price index, another measure of inflation that people might be a little bit more familiar with. Along with that data release that gives us that deflator, they also tell us about disposable personal income. So it's all about what are people making and how are they spending it. And that income component was actually kind of encouraging. Yes, the deflator, the inflation number, looks like we're back on track towards the Fed's 2% target.
So let me just jump in on that because that's important, because the Fed has said for a long time, 50 years plus, that they wanted to get to this 2% target, give or take.
Yep.
And right now, we look at the most recent report, and it suggests that we are there.
Yeah, we are very close to 2.6%, right. So it at least it's within the ballpark of it. And I think that has a lot of people thinking that, do they need to keep holding rates as high as what they are? Because if they wait until they get to 2% before they start cutting, then they are likely to overshoot. They're likely to keep monetary policy too restrictive for too long, which could create all sorts of issues like it has in the past.
In the past, what they did is they kept the rates too low for too long, and that created all of this free money, zero interest rate policy, or ZIRP. Now, the opposite is happening right now. Maybe they're keeping it too high for too long. So there is a possibility that the Fed does make an announcement here.
There is. And I think that one of the big risks that a lot of people think about is, the Fed, as you point out, they held rates too low for too long. They were very late in hiking rates. Are they going to be late in cutting rates? My thought on this is that, as a central bank, as an institution, they learn from previous mistakes. And so they aren't likely to create the same mistakes. It's just they'll create brand new ones. It wouldn't be exactly a new mistake if they waited too long. So I actually think that
We'll have to see. That's a good debate. A cat jumping on a hot stove, right? It only needs to do that one time.
Yep.
But we're going to have to watch that. And the other part that was really important is that we saw savings rates start to nudge up. Not great, but headed in the right direction as well. So inflation coming down, people's income going up, and of course the personal savings rate, because they're not spending as much, going up. That suggests that at least directionally they're headed in the right direction.
That's right. And I think that's really the key thing, especially for somebody like Chair Powell, who, remember, he's a trained lawyer, not a trained economist. And so when he looks at the data, he's very skeptical about forecasts. He wants to see the hard data. Are things moving just directionally? Is it going the right way?
So let me interrupt there, Dr. Brian Jacobsen, owner of a Juris Doctorate. You're an economist and a lawyer, so where does that put you?
Well, that just means that I can always say on the one hand this, on the other hand that. Exactly. But then as a lawyer, I can also speak out of both sides of my mouth.
Very funny. No, we have a lot of our friends are lawyers. Okay, let's change topics, because that was the big news for sure.
Sure.
And really talk about the end of the quarter. It's important because there's a couple of things that happen. Number one is this realignment of these indexes, number one. And number two, we get to the end of the quarter, so it's called window dressing. Let's talk about those two.
Yeah, the whole window dressing and the index realignment. So some of the big ones, like Standard & Poor's, like the S&P 500, we're not going to see a lot of changes there necessarily. But some of the other ones that a lot of institutional asset managers track, like the Russell indices, they do have this reconstitution. So new names go in, other names come out. And so that can create all sorts of movements in the markets as people try to shouldn't really say front run, but they are trying to move in advance of what these really slowly moving indices are trying to do.
For an example, Brian, one of the chip companies had a nice run and now their capitalization is bigger, so that might make a change in one of these holdings.
Absolutely. So somebody could move from, say, the small cap one, which is the Russell 2000, into a larger cap index. And so that means that if you are an asset manager who you track small cap stocks, you might have to sell that. But then anybody who is managing the large cap index, they might have to buy it. And right now in today's environment, as you'd probably imagine, those large cap stocks, there's more of those than there are the small cap managers. So it's probably going to create some buying pressure for those that are migrating from one index up, almost being promoted up to that larger cap one.
All right, let's talk about the elephant in the room versus the donkey in the room, right? It's ironic that those are the two emblems that these parties use. And of course, the elephant in the room was not a great debate for President Biden, and we're starting to see some polls come out. And does that change the way people think and at least the way they invest? And then we're going to have a very interesting number of weeks before the Democratic convention in the first week of August in Chicago. And so we'll have to watch that, because between now and then we could get some volatility.
Oh, yes, especially if, let's say, there has been this rising chorus about whether or not President Biden, should he withdraw from the race?
Or be replaced.
And if you watched the debates, which I think you spent your time very well by watching those other 80-year-olds
exactly.
sing and dance as opposed to watching the debate, because I didn't really learn a lot in terms of their policy stance. To me, it was one of those situations where there was such anticipation of how they would perform, being able to show their stamina, their ability to articulate themselves, and perhaps the bar was set pretty low, and yet they still seem to kind of stumble over it, if not
underneath it.
Yeah,
underneath it, right. So, folks, right now there's a lot going on. The volatility will be there over the next number of weeks. So make sure that you understand how you are aligned, because the world could change quickly over the next number of weeks.